Let's start with a review of real estate finance fundamentals. What is the primary purpose of a balloon payment in a mortgage structure? Is it A, to reduce the interest rate over the loan term, B, to lower monthly payments during the loan term, C, to eliminate the need for a down payment, or D, to increase the loan's amortization period? The correct answer is B, to lower monthly payments during the loan term. A balloon payment is a large payment due at the end of a loan term, allowing for lower monthly payments during the term. Which type of mortgage allows the borrower to pay only the interest for a specified period? Is it A, fixed rate mortgage, B, adjustable rate mortgage, C, interest-only mortgage, or D, reverse mortgage? The correct answer is C, interest-only mortgage. Why this question may seem a bit tricky. Interest-only loans are often confused with adjustable-rate mortgages, but they specifically allow interest-only payments for a set time. John is considering a mortgage that offers lower initial payments but requires a large payment at the end. What type of mortgage is he likely considering? Is it A, balloon mortgage, B, fixed-rate mortgage, C, adjustable rate mortgage, or D, reverse mortgage? The correct answer is A, balloon mortgage. John is likely considering a balloon mortgage, which features lower initial payments and a large final payment. What does LTV stand for in mortgage terminology? Is it A, loan to vendor, B, lease to value, C, lender to value, or D, loan to value? The correct answer is D, loan to value. LTV stands for loan to value, a ratio used to assess lending risk by comparing the loan amount to the property's value. Emily is offered a mortgage with a fixed interest rate for the first 5 years, after which the rate may change annually. What type of mortgage is this? B, hybrid adjustable rate mortgage, C, interest-only mortgage, or D, balloon mortgage? The correct answer is B, hybrid adjustable rate mortgage. Emily is considering a hybrid adjustable rate mortgage, which has a fixed rate initially and then adjusts.
How'd you do on the first 5 questions? Go ahead and subscribe to Birdsey now and turn your progress into exam day confidence. Ready to jump back in? Let's go.
What is the primary characteristic of an adjustable rate mortgage, ARM? Is it A, the interest rate is fixed for the entire loan term, B, the interest rate can change periodically, the loan balance decreases over time, or D, the borrower pays only interest for the first few years? The correct answer is B, the interest rate can change periodically. An adjustable rate mortgage, ARM, features an interest rate that can change periodically based on the performance of a specific index, unlike a fixed-rate mortgage where the rate remains constant. Which mortgage type typically requires a borrower to pay a higher interest rate in exchange for lower initial payments? Is it A, fixed-rate mortgage, B, interest-only mortgage, C, graduated payment mortgage, or D, balloon mortgage? The correct answer is C, graduated payment mortgage. Why this question may seem a bit tricky. Borrowers often confuse lower initial payments with lower overall costs, but in a graduated payment mortgage, the initial lower payments are offset by higher interest rates. Sarah is considering a mortgage where her payments will start low and increase over time. What type of mortgage is she likely considering? Is it A, graduated payment mortgage, B, adjustable rate mortgage, C, balloon mortgage, or D, reverse mortgage? The correct answer is A, graduated payment mortgage. Sarah is likely considering a graduated payment mortgage, which starts with lower payments that increase over time, often to accommodate expected income growth. What does the term amortization refer to in mortgage lending? Is it A, the initial down payment on a property, B, the interest rate adjustment period, C, the final balloon payment, or D, the gradual repayment of loan principal and interest? The correct answer is D, the gradual repayment of loan principal and interest. Amortization refers to the process of gradually paying off a debt over time through regular payments of principal and interest. David is offered a mortgage where he can choose to pay only the interest for the first 10 years. What type of mortgage is this? Is it A, fixed-rate mortgage, B, interest-only mortgage, C, balloon mortgage, or D, reverse mortgage? The correct answer is B, interest-only mortgage. David is likely considering an interest-only mortgage, which allows borrowers to pay only the interest for a set period before principal payments begin. What is the primary feature of a fixed-rate mortgage? Is it A, the interest rate remains constant throughout the loan term, B, the interest rate adjusts annually based on market conditions, C, the borrower pays only interest for the first few years, or D, the loan term is typically shorter than 15 years? The correct answer is A, the interest rate remains constant throughout the loan term. A fixed-rate mortgage maintains the same interest rate throughout the loan term, providing predictable monthly payments. Which mortgage type typically offers lower initial payments but may result in negative amortization? Is it A, fixed-rate mortgage, B, option adjustable rate mortgage, option ARM, C, interest-only mortgage, or D, balloon mortgage? The correct answer is B, option adjustable rate mortgage, option ARM. Why this question may seem a bit tricky. Negative amortization occurs when payments are less than the interest due, increasing the loan balance. This is a feature of option ARMS, not typical ARMS. Lisa is considering a mortgage that allows her to make smaller payments initially, with the risk of owing more than the original loan amount. What type of mortgage is she likely considering? Is it A, fixed-rate mortgage, B, interest-only mortgage, C, option adjustable rate mortgage, option ARM, or D, balloon mortgage? The correct answer is C, option adjustable rate mortgage, option ARM. Option ARMs allow for smaller initial payments, which can lead to negative amortization, increasing the loan balance over time. Tom is offered a mortgage where the interest rate is fixed for the first 5 years and then adjusts annually. What type of mortgage is this? B, interest-only mortgage, C, balloon mortgage, or D, hybrid adjustable rate mortgage, hybrid ARM? The correct answer is D, hybrid adjustable rate mortgage, hybrid ARM. This describes a hybrid ARM, which combines features of fixed rate and adjustable rate mortgages.
If you want more than just rapid-fire questions, head over to birdsey.ai. You can take unlimited practice exams and get instant help from your personal AI study partner. It's like having a tutor 24/7. Try it free. You'll find a link in the description.
Interest rates, discount points, and APR basics. What is the primary purpose of discount points in real estate finance? B, to lower the interest rate, C, to extend the loan term, or D, to reduce closing costs? The correct answer is B, to lower the interest rate. Discount points are used to lower the interest rate on a mortgage loan, effectively reducing the monthly payment and total interest paid over the loan's life. If a borrower pays 2 discount points on a $200,000 loan, what is the cost of these points?
Is it A, $2,000,
B, $3,000, C, $4,000, or D, $5,000? The correct answer is C, $4,000. Why this question may seem a bit tricky. The cost of discount points is calculated as a percentage of the loan amount. Each point is 1% of the loan, so 2 points cost $4,000. Sarah is considering a mortgage with a 4% interest rate and another with a 3.5% rate, plus 2 discount points. Which option should she choose if she plans to stay in the home for 10 years? Is it A, the 4% interest rate option? B, the 3.5% rate without considering points? C, either option as they are equivalent? Or D, the 3.5% rate with points if savings exceed costs in 10 years? The correct answer is D, the 3.5% rate with points if savings exceed costs in 10 years. Sarah should calculate the break-even point for the discount points. If the savings from the lower rate exceed the cost of points within 10 years, the 3.5% option is better. How is the annual percentage rate APR different from the nominal interest rate? Is it A, APR includes fees and costs beyond the interest rate? B, APR is always lower than the nominal rate? C, APR only considers the interest rate? Or D, APR is calculated monthly? The correct answer is A. APR includes fees and costs beyond the interest rate. The APR includes both the nominal interest rate and additional costs or fees, providing a more comprehensive view of the loan's cost. Which of the following statements about interest rates and APR is true? Is it A, interest rates always include all loan fees? B, APR provides a more complete cost of borrowing than interest rates? C, APR is only relevant for fixed-rate loans? Or D, interest rates are typically higher than APR? The correct answer is B. APR provides a more complete cost of borrowing than interest rates. Why this question may seem a bit tricky, APR includes fees and costs, making it a more comprehensive measure than the nominal interest rate, which only reflects the cost of borrowing. What is the primary effect of paying discount points on a mortgage? Is it A, it reduces the interest rate on the loan? B, it increases the loan amount? C, it shortens the loan term? Or D, it eliminates the need for a down payment? The correct answer is A. It reduces the interest rate on the loan. Paying discount points reduces the interest rate on a mortgage, which can lower monthly payments and total interest paid over the loan's life. Which of the following best describes the relationship between APR and the nominal interest rate? Is it A, APR is always lower than the nominal interest rate? B, APR includes fees and reflects the true cost of borrowing? C, nominal interest rate includes all fees and costs? Or D, APR and nominal interest rate are always equal? The correct answer is B. APR includes fees and reflects the true cost of borrowing. Why this question may seem a bit tricky. APR includes fees and other costs, while the nominal rate does not. The nominal rate is often lower, but it doesn't reflect the true cost of borrowing. John is choosing between a 30-year mortgage at 3.75% with no points and a 3.5% rate with 1 point. If he plans to stay for 15 years, which option is more cost-effective? Is it A, the 3.75% rate with no points? B, the 3.5% rate with 1 point if staying less than 5 years? C, the 3.5% rate with 1 point if staying for 15 years? Or D, Both options are equally cost-effective. The correct answer is C, the 3.5% rate with 1 point if staying for 15 years. The lower rate with 1 point is more cost-effective over 15 years as the interest savings outweigh the upfront cost of the point. How does the annual percentage rate, APR, help consumers compare loans? Is it A, by showing the monthly payment amount, B, by indicating the loan term, C, by detailing the principal amount, or D, by reflecting the total cost of borrowing, including fees? The correct answer is D, by reflecting the total cost of borrowing, including fees. APR provides a comprehensive measure of the cost of borrowing, including interest and fees, allowing consumers to compare loans more effectively. Lisa is offered a mortgage with a 4% interest rate and another with a 3.75% rate, plus 2 discount points. If she plans to sell the house in 5 years, which option is better? Is it A, the 4% interest rate with no points, B, the 3.75% rate with 2 points if staying for 10 years, the 3.75% rate with 2 points if staying for 5 years, or D, both options are equally beneficial? The correct answer is A, the 4% interest rate with no points. The 4% rate is better for a short-term stay, as the cost of points may not be recouped in 5 years. Loan qualification, underwriting ratios, and borrower capacity. What is the primary purpose of the debt-to-income DTI ratio in loan qualification? Is it A, to determine the interest rate on a loan, B, to evaluate a borrower's ability to manage monthly payments, C, to calculate the maximum loan amount a borrower can receive, or D, to assess the value of the property being financed? The correct answer is B, to evaluate a borrower's ability to manage monthly payments. The DTI ratio is used to assess a borrower's ability to manage monthly payments and repay debts. It compares the borrower's monthly debt payments to their gross monthly income. Which of the following ratios is typically used to evaluate a borrower's housing expense capacity? Is it A, front-end ratio, B, back-end ratio, C, loan-to-value ratio, or D, interest coverage ratio? The correct answer is A, front-end ratio. Why this question may seem a bit tricky. The housing expense ratio, also known as the front-end ratio, specifically measures housing costs against income, unlike other ratios that include broader debt obligations. If a borrower has a gross monthly income of $5,000 and monthly debt obligations of $1,500, what is their back-end DTI ratio? Is it A, 20%, B, 25%, C, 30%, or D, 35%? The correct answer is C, 30%. Why this question may seem a bit tricky. The back-end DTI ratio includes all monthly debt obligations, not just housing expenses, and is calculated by dividing total debt by gross income. Jane is applying for a mortgage with a monthly payment of $1,200. Her other monthly debts total $600, and her gross monthly income is $4,000. What is her front-end DTI ratio? Is it A, 15%, B, C, 45%, or D, 50%? The correct answer is B, 30%. The front-end DTI ratio only considers housing expenses. It is calculated as $1,200 housing expense divided by $4,000 gross income, resulting in 30%. Tom is considering a loan that requires a maximum back-end DTI ratio of 36%. If his gross monthly income is $6,000, what is the maximum total monthly debt payment he can have to qualify? Is it A, $1,800, B, $2,000, C, $2,100, or D, $2,160? The correct answer is D, 2,160. The maximum back-end DTI ratio of 36% means Tom's total monthly debt payments should not exceed 36% of his gross income, which is $2,160. Sarah is applying for a mortgage with a monthly payment of $1,500. Her other monthly debts total $700, and her gross monthly income is $5,000. What is her back-end DTI ratio? Is it A, 30%, B, 36%, C, or D, 50%? The correct answer is C, 44%. The back-end DTI ratio includes all monthly debt payments divided by gross monthly income. Here, $1,500 plus $700 over $5,000 equals 44%.
Have you noticed the code in the bottom corner? The next time you're stumped, take that code to birdsey.ai. You'll get immediate help, complimentary study sessions, and access to hundreds of additional questions. It's the best tool to help you pass with confidence.
Financing calculations and exam math. Amortization, payment structures, and interest calculations. What is the primary purpose of an amortization schedule in loan repayment? Is it A, to show the breakdown of each payment into principal and interest? B, to determine the loan's interest rate? C, to calculate the total amount of interest paid over the loan term? Or D, to adjust monthly payments based on changes in interest rates? The correct answer is A, to show the breakdown of each payment into principal and interest. An amortization schedule outlines each payment's allocation between principal and interest over the loan term, helping borrowers understand how their payments reduce the loan balance. If a borrower makes extra payments on a fixed-rate mortgage, what is the most likely effect on the loan? Is it A, the interest rate will decrease? B, the loan term will be shortened? C, the monthly payment will decrease? Or D, the total interest paid will increase? The correct answer is B, the loan term will be shortened. Why this question may seem a bit tricky. Extra payments reduce the principal faster, shortening the loan term, not the interest rate or monthly payment. Sarah has a 30-year fixed mortgage and decides to pay an additional $200 each month. How does this affect her loan? Is it A, her interest rate will be reduced? B, her monthly payment will decrease? Or D, her total interest paid will increase? The correct answer is C, her loan term will be shortened. Extra payments reduce the principal balance faster, leading to a shorter loan term and less total interest paid. What does the term amortization refer to in the context of a loan? Is it A, the initial loan amount? B, the interest rate applied to the loan? C, the total interest paid over the loan term? Or D, the process of paying off a loan through regular payments? The correct answer is D, the process of paying off a loan through regular payments. Amortization refers to the process of spreading out a loan into a series of fixed payments over time. John is considering refinancing his mortgage to a lower interest rate. What should he consider about the amortization schedule? Is it A, refinancing may reset the amortization schedule? B, refinancing will not affect the amortization schedule? C, refinancing guarantees a shorter loan term? Or D, refinancing will increase the monthly payment? The correct answer is A, refinancing may reset the amortization schedule. Refinancing can reset the amortization schedule, potentially extending the loan term and affecting total interest paid. What is the effect of a higher interest rate on the monthly payment of a fixed-rate mortgage? Is it A, decreases the monthly payment, B, keeps the monthly payment the same, C, increases the monthly payment, or D, has no effect on the monthly payment? The correct answer is C, increases the monthly payment. A higher interest rate increases the amount of interest paid each month, thus raising the monthly payment on a fixed-rate mortgage. If a borrower pays off a loan early, what happens to the total interest paid over the life of the loan? Is it A, total interest decreases, B, total interest remains the same, C, total interest increases, or D, total interest is unaffected by early payoff? The correct answer is A, total interest decreases. Why this question may seem a bit tricky. Early payoff reduces the total interest because interest is calculated over time, and less time means less interest accrues. Emily has a 15-year fixed mortgage with a 4% interest rate and decides to refinance to a 3% rate. How does this affect her monthly payments? Is it A, increases her monthly payments, B, decreases her monthly payments, keeps her monthly payments the same, or D, doubles her monthly payments? The correct answer is B, decreases her monthly payments. Refinancing to a lower rate typically reduces monthly payments, assuming the loan term remains the same. How is the principal portion of a loan payment affected over time in an amortizing loan? Is it A, decreases over time, B, remains constant, C, varies unpredictably, or D, increases over time? The correct answer is D, increases over time. In an amortizing loan, the principal portion of the payment increases over time as the interest portion decreases. Tom is considering an interest-only loan for the first 5 years. What should he expect about his payments after this period? Is it A, payments will increase, B, payments will decrease, C, payments will remain the same, or D, payments will be eliminated? The correct answer is A, payments will increase. After the interest-only period, payments typically increase as they begin to include principal repayment. LTV, CLTV, DTI, and income computations for real estate loans. What does LTV stand for in real estate financing? Is it A, loan to value, B, loan to venture, C, lease to value, or D, lease to venture? The correct answer is A, loan to value. LTV stands for loan to value ratio, which is a financial term used by lenders to express the ratio of a loan to the value of an asset purchased. If a borrower has a monthly gross income of $5,000 and monthly debt obligations of $1,500, what is their DTI ratio? Is it A, 20%, B, 25%, C, 30%, or D, 35%? The correct answer is C, 30%. Why this question may seem a bit tricky. The DTI ratio is calculated by dividing total monthly debt by gross monthly income. Here, $1,500 divided by $5,000 equals 0.30, or 30%. John is buying a house valued at $300,000 with a loan of $240,000. What is his LTV ratio? Is it A, 70%, B, 80%, C, 85%, or D, 90%? The correct answer is B, 80%. The LTV ratio is calculated by dividing the loan amount by the property value, Here, $240,000 divided by $300,000 equals 0.80 or 80%. What does CLTV stand for in real estate financing? Is it A, current loan to value, B, cumulative loan to value, C, collateral loan to value, or D, combined loan to value? The correct answer is D, combined loan to value. CLTV stands for Combined Loan to Value Ratio, which considers all loans on a property relative to its value. Sarah's monthly gross income is $6,000, and her monthly debt payments are $2,000. If she wants to keep her DTI ratio below 36%, how much more debt can she afford? Is it A, $160, B, $360, C, $600, or D, $1,000? The correct answer is A, $160. To keep the DTI below 36%, her total debt should not exceed $2,160, which is 36% of $6,000. She can afford $160 more in debt. What is the primary purpose of calculating the loan-to-value (LTV) ratio in real estate financing? Is it A, to determine the interest rate of the loan, B, to assess the risk of the loan, C, to calculate the borrower's credit score, or D, to establish the property's market value? The correct answer is B, to assess the risk of the loan. The LTV ratio helps lenders assess the risk of a loan by comparing the loan amount to the appraised value of the property. A higher LTV indicates more risk. If a borrower has a monthly gross income of $8,000 and monthly debt obligations of $3,000, what is their debt-to-income DTI ratio? Is it A, 25%, B, 30%, C, 37.5%, or D, 40%? The correct answer is C, 37.5%. Why this question may seem a bit tricky. The DTI ratio is calculated by dividing total monthly debt by gross monthly income, then multiplying by 100 to get a percentage. Emily is purchasing a home for $400,000 and is taking out a first mortgage of $320,000 and a second mortgage of $40,000. What is her combined loan-to-value (CLTV) ratio? Is it A, 90%, B, 80%, C, 85%, or D, 95%? The correct answer is 90%. The CLTV ratio is calculated by adding all loans and dividing by the property value. Here, $320,000 plus $40,000 divided by $400,000 equals 90%.
Did you get a different answer? Or maybe you have a question about the exam in general? Drop it in the comments below. We read and answer them personally.
Closing costs, prorations, and finance-related settlement math. What is the purpose of prorating property taxes at closing? Is it A, to reduce the overall closing costs, B, to fairly divide the tax responsibility between buyer and seller, C, to adjust the interest rate on the mortgage, or D, to calculate the seller's net proceeds? The correct answer is B, to fairly divide the tax responsibility between buyer and seller. Prorating property taxes ensures that both the buyer and seller pay their fair share of taxes for the time they own the property during the tax year. If a buyer pays $1,200 in prepaid interest at closing, what does this amount represent? Is it A, a reduction in the principal amount of the loan, B, an escrow deposit for future interest payments, C, interest paid in advance for the period before the first mortgage payment, The correct answer is C. Interest paid in advance for the period before the first mortgage payment. Why this question may seem a bit tricky. Prepaid interest is often confused with other closing costs. It represents interest paid in advance for the period between closing and the first mortgage payment. John is selling his house, and the closing date is set for June 15th. The annual property taxes of $3,600 have been paid in full by John. How much should the buyer reimburse John for the taxes at closing? Is it A, $1,964.38, B, $1,800, or D, $1,200? The correct answer is A, $1,964.38. The buyer reimburses John for taxes from June 15th to December 31st, which is 199 days. The daily tax rate is $3,600 divided by 365, so the buyer owes John for 199 days. What is typically included in the closing costs for a home purchase? Is it A, only the down payment, B, only the real estate agent's commission, C, only the property taxes, or D, appraisal fees, title insurance, and loan origination fees? The correct answer is D, appraisal fees, title insurance, and loan origination fees. Closing costs generally include fees for services such as appraisal, title insurance, and loan origination, among others. Maria is buying a home with a closing date of April 30th. The seller has already paid the annual property taxes of $4,800. How much should Maria reimburse the seller for the taxes at closing? Is it A, $1,600, B, $3,200, C, $4,800, or D, $2,400? The correct answer is B, $3,200. Maria should reimburse the seller for the taxes from May 1st to December 31st, which is 8 months. The prorated amount is $4,800 divided by 12 multiplied by 8, which equals $3,200. Emily is purchasing a property with a closing date of September 10th. The seller has already paid the annual Homeowners Association HOA fees of $1,200 for the year. How much should Emily reimburse the seller for the HOA fees at closing? Is it A, $300, B, $400, C, $600, or D, $900? The correct answer is B, $400. Emily needs to reimburse the seller for the portion of the HOA fees covering September 10th to December 31st. This is calculated by prorating the annual fee over the remaining months. Valuation principles and appraisal methods. Market value concepts, forces of value, and principles of supply and demand. What is the primary factor that determines the market value of a property? Is it A, the cost of construction, B, supply and demand, C, the historical price of the property, or D, the owner's investment in the property? The correct answer is B, supply and demand. Market value is primarily determined by the interaction of supply and demand in the market, reflecting what buyers are willing to pay and sellers are willing to accept. Which principle of value suggests that a property's value is influenced by the cost of acquiring an equally desirable substitute? Is it A, principle of contribution, B, principle of anticipation, C, principle of substitution, or D, principle of conformity? The correct answer is C, principle of substitution. Why this question may seem a bit tricky. The principle of substitution is often confused with other valuation principles, but it specifically relates to the cost of acquiring a substitute property. A homeowner is considering selling their property in a neighborhood where new developments are increasing supply. How might this affect the market value of their home? Is it A, the market value may decrease due to increased supply? B, the market value will increase as new developments attract more buyers? Or D, the market value will increase due to improved neighborhood amenities? The correct answer is A, the market value may decrease due to increased supply. Increased supply in the market typically leads to lower prices as more options become available to buyers, potentially decreasing market value. Which economic principle states that the value of a property is affected by its potential to generate future income? Is it A, principle of conformity, B, principle of substitution, C, principle of contribution, or D, principle of anticipation? The correct answer is D, principle of anticipation. The principle of anticipation suggests that value is based on the present worth of future benefits, such as income potential. A real estate investor is evaluating a property in a rapidly growing area where demand is outpacing supply. What is the likely impact on the property's market value? Is it A, the market value will decrease due to high demand? B, the market value will increase as demand exceeds supply? C, the market value will remain stable despite high demand? Or D, the market value will decrease due to increased competition? The correct answer is B, the market value will increase as demand exceeds supply. When demand exceeds supply, prices typically rise as buyers compete for limited properties, increasing market value. Which principle of value suggests that a property's worth is determined by the cost of acquiring an equally desirable substitute property? Is it A, principle of anticipation, B, principle of substitution, C, principle of contribution, or D, principle of conformity? The correct answer is B, principle of substitution. The principle of substitution states that a property's value is influenced by the cost of acquiring a similar property. Buyers will not pay more for a property than the cost of a comparable substitute. In a market where demand is constant but supply increases, what is the likely effect on property values? Is it A, property values will likely decrease, B, property values will likely increase, C, property values will remain unchanged, or D, property values will fluctuate unpredictably? The correct answer is A, property values will likely decrease. Why this question may seem a bit tricky. It tests understanding of supply and demand dynamics. Increased supply with constant demand typically leads to lower prices, as more options are available for buyers. A developer is planning to build a new housing complex in an area where demand is high but supply is limited. What is the likely impact on the market value of existing properties in the area? Is it A, the market value of existing properties will decrease, B, the market value of existing properties will remain stable, C, the market value of existing properties will increase, or D, the market value of existing properties will become volatile? The correct answer is C, the market value of existing properties will increase. High demand and limited supply typically increase property values. New developments can further drive up demand, enhancing the value of existing properties. Sales comparison approach and exam-style adjustment problems. In the sales comparison approach, what is the primary purpose of making adjustments to the comparable properties? Is it A, to increase the value of the subject property, B, to account for differences between the comparable and subject properties, C, to reflect market trends, or D, to standardize property values? The correct answer is B, to account for differences between the comparable and subject properties. Adjustments are made to comparable properties to account for differences between them and the subject property, ensuring a more accurate valuation. When adjusting for location differences in the sales comparison approach, which factor is most critical? Is it A, square footage, B, age of the property, C, proximity to amenities, or D, number of bedrooms? The correct answer is C, proximity to amenities. Why this question may seem a bit tricky. Location adjustments can involve multiple factors, but proximity to amenities is often most critical in valuation. A real estate appraiser is evaluating a property with a pool, while the comparable property lacks one. What adjustment should be made? Is it A, add value to the comparable property, B, subtract value from the subject property, C, no adjustment is necessary, or D, subtract value from the comparable property? The correct answer is A, add value to the comparable property. The appraiser should add value to the comparable property to account for the pool's absence, aligning it with the subject property. What is the first step in the sales comparison approach to valuation? Is it A, adjusting for differences, B, calculating the average price, C, determining the subject property's value, or D, identifying comparable properties? The correct answer is D, identifying comparable properties. The first step is identifying comparable properties that have recently sold, providing a basis for comparison. An appraiser finds that a comparable property sold for $300,000 but had a superior kitchen renovation compared to the subject property. Is it A, add value to the subject property, B, subtract value from the comparable property, C, no adjustment is necessary, or D, add value to the comparable property? The correct answer is B, subtract value from the comparable property. The appraiser should subtract value from the comparable property to account for the superior kitchen, aligning it with the subject property. An appraiser is evaluating a property that has a larger lot size compared to a comparable property. How should the appraiser adjust the value of the comparable property? Is it A, adjust the comparable property value downward, B, make no adjustment, C, adjust the comparable property value upward, or D, adjust the subject property value downward? The correct answer is C, adjust the comparable property value upward. The appraiser should adjust the value of the comparable property upward to account for the smaller lot size. This ensures the comparison reflects the subject property's larger lot advantage. Cost approach, depreciation calculations, and income approach basics. What is the primary purpose of the cost approach in real estate valuation? Is it A, to determine market trends, to estimate the value based on replacement cost, C, to calculate potential rental income, or D, to assess property tax values? The correct answer is B, to estimate the value based on replacement cost. The cost approach estimates the value of a property by determining the cost to replace or reproduce it, minus depreciation. It is often used when comparable sales are not available. In the income approach, what is the capitalization rate primarily used for? Is it A, to calculate depreciation, B, to determine operating expenses, C, to convert income into an estimate of value, or D, to assess market demand? The correct answer is C, to convert income into an estimate of value. Why this question may seem a bit tricky, the capitalization rate is often confused with other financial metrics. It is used to convert income into an estimate of value. not to calculate depreciation or expenses. A property owner wants to estimate the value of their building using the cost approach. They know the replacement cost is $500,000 and the building has depreciated by 20%. Is it A, $400,000, B, $500,000, C, $600,000, or D, $300,000? The correct answer is A, $400,000. The estimated value is calculated by subtracting depreciation from the replacement cost. Here, 20% of $500,000 is $100,000, so the value is $400,000. Which method of depreciation calculation involves estimating the loss in value due to physical wear and tear? Is it A, functional obsolescence, B, economic obsolescence, C, replacement cost, or D, physical deterioration? The correct answer is D, physical deterioration. Physical deterioration refers to the loss in value due to wear and tear, which is a key aspect of depreciation calculations. A real estate investor is evaluating a property using the income approach. The property generates $50,000 in annual net operating income, and the market capitalization rate is 10%. What is the estimated value of the property? Is it A, $5,000, B, $500,000, C, $50,000, or D, $5 billion? The correct answer is B, $500,000. The estimated value is calculated by dividing the net operating income by the capitalization rate. 50,000 divided by 0.10 equals 500,000. A developer is assessing a new building project using the cost approach. The replacement cost is estimated at $750,000, and the building has depreciated by 15% due to physical wear. Is it A, $750,000, B, $637,500, C, $600,000, or D, $675,000? The correct answer is C, $600,000. The cost approach involves subtracting depreciation from the replacement cost. Here, 15% of $750,000 is $112,500. So the current value is $750,000 minus $112,500, which equals $637,500. Investment analysis and practical exam concepts. Cap rates, GRM, cash flow and return calculations. What does the cap rate represent in real estate investment analysis? Is it A, the total cost of acquiring a property, B, the rate of return on a property based on its income, C, the annual appreciation rate of a property, or D, the interest rate on a mortgage for the property? The correct answer is B, the rate of return on a property based on its income. The cap rate is a measure of the rate of return on a real estate investment property based on the income that the property is expected to generate. Sarah is evaluating a rental property that generates $50,000 in annual net operating income and is priced at $500,000. What is the cap rate for this property? Is it A, 10%, B, 5%, C, 15%, or D, 20%? The correct answer is A, 10%. The cap rate is calculated by dividing the net operating income by the property value, which in this case is 10%. John is considering an investment property that costs $300,000 and has an expected annual cash flow of $30,000. What is the cash-on-cash return? Is it A, 5%, B, 10%, C. 15%. Or D. 20%. The correct answer is B. 10%. The cash-on-cash return is calculated by dividing the annual cash flow by the total cash invested, which is 10% in this scenario. Emily is analyzing a potential investment property that costs $400,000 and generates a monthly rental income of $3,000. She wants to calculate the gross rent multiplier, or GRM, to assess the investment. What is the GRM for this property? Is it A, 10.5, B, 11.1, C, 12.5, or D, 13.3? The correct answer is B, 11.1. The GRM is calculated by dividing the property's price by its annual rental income. Here, $400,000 divided by $36,000 gives a GRM of 11.1. IRR, discounted valuation, and basic investment decision metrics. What does the internal rate of return, IRR, indicate in investment analysis? Is it A, the total profit from an investment, B, the discount rate that makes the NPV of cash flows 0, the future value of an investment, or D, the payback period of an investment? The correct answer is B, the discount rate that makes the NPV of cash flows 0. The IRR is the discount rate that makes the net present value, NPV, of all cash flows from a particular project equal to 0. It is used to evaluate the attractiveness of a project or investment. Maria is evaluating two projects with different cash flow patterns. Project A has an IRR of 12%, while Project B has an IRR of 15%. If Maria's required rate of return is 10%, which project should she choose based on IRR? Is it A, Project A, because it has a lower risk? B, neither, because both IRRs are above the required rate? C, Project B, because it has a higher IRR than Project A? Or D, Project A, because it has a more stable cash flow? The correct answer is C, Project B, because it has a higher IRR than Project A. Maria should choose Project B because its IRR of 15% is higher than both Project A's IRR and her required rate of return, indicating a better potential return. Risk, leverage, and investor considerations in property evaluation. What is the primary risk associated with using high leverage in property investment? Is it A, increased liquidity, B, amplified losses, C, reduced tax benefits, or D, improved cash flow? The correct answer is B, amplified losses. High leverage increases the potential for higher returns, but also amplifies the risk of significant losses if property values decline. Sarah is evaluating a property investment with a high loan-to-value ratio. She is concerned about potential risks. What should she primarily consider in her analysis? Is it A, the property's location, B, the current interest rates, C, the risk of property value decline, or D, the potential for rental income? The correct answer is C, the risk of property value decline. A high loan-to-value ratio means Sarah should focus on the risk of property value decline, which could lead to negative equity.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.